Good afternoon, profit seekers and fellow capitalists. This is your growth stock guru, Rick Action Jackson. Thank you for joining us today. We're going to have some fun. We're going to talk about some stocks that people have either emailed or text that I comment on. And what we're going to do is put them in the relationship of would our top quintile strategy make it a buy or a sell? And then I'll also comment on whether I think this is a quality stock or speculative. But before we get into that, let me remind you, this is purely education and entertainment. Do not act on any of these ideas without consulting your financial consultant. Individual stocks are risky. You can lose money, and you should not be acting on this stuff if you're a beginner without professional advice. Okay, so we got someone here from Monroe, Connecticut, Renee. She said, Dell, buy, hold, or sell. Great. We're starting off with an easy one. Well, I was all over Dell Computer back in October of 25 when they said on the conference call that their AI servers are selling at a much quicker pace than they expected, and they increased their forecast on growth from 3 to 5% revenue and 8 to 10% profit up to 8 to 10% revenue and 12 to 15% profit. That's a big deal. I've known Dell Computer for 20 years, 30 years. Michael Dell almost never misses a number. He puts a number out there, he makes it, and he usually beats it. So it was a pretty dull stock for about 6 months, but Dell has been beating the numbers 5 quarters in a row. And last quarter, they had a blowout, and the stock took off like an animal. They came in $1.90 for the quarter above the expectation, and the expectation was just under $2 a share. So they came in at $3.90 for the quarter. The stock took off. Let's take a look at the chart here. This is the 1-year chart. This is where we got involved. And the stock actually went down a little bit. We were able to buy a little bit more, under $100. We were buying it up around 150, 140. Able to buy some more under 100. And then here's the big quarter. Boom, right here. Stock was moving up ahead of time because Dell did warn the street that their revenues were coming in ahead of plan for the quarter. And then when they announced it, look at this. This is called a gap. Now, this means one of two things. Either there was a shortage of stock for sale when the quarter was reported, and the what do you call it? The bulls went crazy and caused the stock to lift $120 in a day. And then it pulled back, gave back about a third to 40% of the gains, and now we're right back close to where we were. Now, when you see a gap like this in a stock, it means one of two things. One, there was a shortage of stock at the time the news broke, caused the stock to go up more than it should have. We call that overbought. Or this is the beginning of a huge run. Now, I can come up with targets on Dell as high as $800 in 2 years. But these gaps always scare me because more times than not, what I've done is I've seen these stocks do what the old wise men say, which is you can't really break free on a stock like this until the stock comes down and fills the gap, meaning the stock would have to come back and kiss 315, 330 before it could go on a breakout into the 500s, 600s. That old wise tale doesn't always work, though. If you got the right product in the right market at the right time, a stock can explode and not look back. So I've sold 2/3 of my position. I still have a third. Would I buy more here? I struggle with this one. If you love the story, if you love the stock, if you love the management, and you're willing to own it for 2 years or more, I would buy a third to a half of a position here and hope you can buy more lower. But if the stock builds a nice base, meaning it's going to trade sideways for a while and allow it to launch up into the 500s, I would pay a little bit more than I'm paying today to fill out the position, but I'd want to keep half of the money out of it for a while, just in case it does go back and test that 330. I'm a buyer. at the 330, 350 level. What put this stock on fire? Basically, NVIDIA. NVIDIA has anointed Dell as their vendor of choice for their new top-of-the-line GPU chip. And Dell is happy to be the company that puts everything together for that motherboard and sell it out into the market. The big advantage Dell has a very tight alliance with Micron. And Dell signs long-term contracts with Micron. They very, very rarely can't get enough DRAM because when DRAM's cheap, Dell pays more in the market. But when DRAM's expensive and short on supply like it is now, Dell is the first person that gets their DRAM shipment. So they're not going to be constrained like other PC makers or server makers because they can't get components. They're going to get the components they need. So I definitely think the stock's going higher. Under our discipline, the stock's cheap enough to buy. It is beat the numbers the last 8 quarters in a row. And Michael Dell has a reputation for beating the numbers consistently. I think back in the 90s, he might have missed the number once in 2 years. So I regret I sold 2/3 of the position. I thought the stock would pull back to 300. I sold it at 420, but I would buy it back under 400. If I didn't own it, I'd buy a little bit here, but be ready to buy more if it pulls back. And if it breaks out above 450 and it's built a base, meaning it's going to trade sideways for another month, I would buy more. But it's a high-quality company. It's in the right market at the right time. And I do believe the CPU revolution, the data center revolution, is not in the late stage of the game. It's still early. So you want to own Dell, and don't buy all of it at once. Buy a little here, buy a little later, buy more if there's a dip. Okay, so that's Dell. Next one we got here, this is from Tony in Mineola, Fluor Corp. He said his uncle works there and loves the company. I love the company too, Tony. They are in all the right businesses. They build factories. They build natural gas and oil refineries. They build chemical plants. Basically, if you want to build $1 billion factory in America, Fluor is on your short list as to who is going to be the general contractor. Problem I got with Fluor is they have not made a number in 6 quarters. They have missed the earnings forecast that they've given Wall Street 6 quarters in a row. Either the CFO is incompetent or the CEO is incompetent. There's something wrong here. And until they can start meeting the numbers that they give to people that they say they're going to make, and they don't make it, until they stop doing that, I'm not touching this. But it's a reasonably priced stock. It's a high-quality company. It's got a great balance sheet. It's one of the best construction companies in the world. But for some reason, they're not making their numbers. And companies that don't make their numbers don't go up. And look at this chart here. This is the 1-year chart. They missed a number back in August of 25. The stock dropped from 53 to 42, and it's been bouncing between 42 and 53 ever since. Every time it gets up near 53 again, guess what happens? They report a quarter and they miss the number. You go back 5 years. This is a great company. Long term, this is a good stock. You want to put a stock away, lock it up, not worry about it for a long time. This would be on a short list, but until they start making their numbers, I'm not touching it. Okay, so Alex in Manhattan says, Apple Computer, it's a time to buy more. I was buying more of Apple when it was back around 265, 275. It's pulling back here. If it pulled back under 290, I would continue to buy it. Apple's beat the numbers every quarter for the last 6 quarters. They're doing moderate growth. They're growing about 6 to 8% in revenue and 8 to 11% in profit. That's nothing to get excited about. It's an expensive stock, but the average iPhone out there is almost 6 years old. For the last 25 years, Apple's been able to come up with stuff that gets more than half of their iPhone owners to want to upgrade in less than 3 years. They haven't given anyone a good reason to upgrade in a long time. However, they're working on an AI application. the AI application is going to require more power and more memory. So when they come up with this AI application, meaning you're going to be able to probably either ask Google Gemini or ask Anthropic for answers on your phone and get back detailed answers. Today you can get short answers from Copilot on your Apple phone, but it's tough to do any serious work. They put a new person in charge of this new product. He's been complimented as being one of the smartest people in the firm since Steve Jobs left, one of the most creative minds. Just got the nod to replace Tim Cook at the end of the year as CEO. I would say somewhere between September, which I think is too early, but some people are saying Apple's going to be ready by September with their Gemini phone. And sometime next year, they will roll out an iPhone that will give you a lot of AI capability, and that will probably cause the biggest phone upgrade cycle in history. It's over 1 billion Apple phones out there. I would bet you if you put a really good AI application on an iPhone, they would get 200 or 300 million upgrades. That would be almost double the phone sales Apple's doing now. Stock would fly on that. So I'm price sensitive. I don't want to chase it. The breakout might be as long as 18 months away. But I do think Apple at 250 is a steal. At 275 to 290, it's very attractive. And I wouldn't tell you to not buy it here if you didn't own any of it, but I would buy more on pullbacks because I think we're going to get some head fakes on this. I don't think this Gemini phone is going to be ready for prime time for a while. But I do think Apple's made a decision to do the alliance with Google on this, not try to invent it themselves. It's going to save them a lot of money. It's going to save them a lot of time. And I'm not the biggest AI expert out there, but the AI people who I really respect, they're all saying Gemini is positioning itself to be the best AI platform in the future. So if you're going to team up with somebody, Apple might as well be the best. All right, so that's it for Apple. Here are my targets for Apple. My 2020 December 2028 target is 420. So if we want to make 50% on it, you want to get it under 290, 285. Next one's Oracle. Oracle is from Molly in Narragansett. Okay, Molly. Oracle, I've always had a love-hate relationship with because they tend to push it on their forecasts, and they'll miss 1 or 2 out of 4 every year. But they do always try to push the company to grow faster than you would think they could grow, and they pull it off half the time. Now they're betting the bank on becoming one of the biggest, if not the biggest, cloud application provider. They've signed some massive contracts with OpenAI and Anthropic, and their biggest problem is they don't have enough cash to build all these things. So they're either going to have to do a secondary of stock, or they're going to have to borrow a lot of money and make people nervous about all the debt they have. But the revenue growth here is solid. They have beat the numbers 5 of the last 6 quarters, but they did miss the quarter 2 quarters ago, which is what drove the stock down here into the low, close to 130, 140. The growth here is undeniable. The questions are, how much is their capital going to cost, and how big is the profit going to be when they've got all these data centers up and running? Some people say the operating margins could be as high as 40%. Some say it could be as low as 15%. You could drive a truck through that difference. I don't think this is a stock you have to own, but it's a high-quality stock. It's one of the players of the future. It doesn't qualify for our strategy because it missed the earnings 2 quarters ago, but if it beats the earnings again next quarter, like it did the last quarter, it would qualify, and it would probably send the stock up over 200 rather than own the stock at 187 than 200 plus. So no, it's not a buy in my strategy, but I do think it's a high-quality company. It's one of the top 10 companies in the NASDAQ 100. And I don't think you get hurt buying it here under 200 if you're willing to give it 2 years. And if it dropped back down into the 160s, 150s, I think you have to buy it if you're a long-term investor. But it's not part of the strategy. And if I did buy it, I wouldn't make it a large position. I would make it a large position the day they report a blowout quarter, and they've also shown Wall Street how they're going to finance all this building. There's nothing terrible about a company doing a secondary if they have more growth in front of them than they can afford to pay for. But when you do a secondary, you're issuing more stock. So if you have 100 million shares and you sell another 20 million to the public, if you owned 10 million shares, you don't own 10% anymore. You own 8%. Now, with that capital, if they're going to grow more than 25%, no worries. I think Oracle can grow more than 25% a year for a few years. I do think this is a $400 to $500 stock. My current target is $275. So ideally, we want to buy it somewhere around 180 or less. But if I did buy it here, I would buy it with the thought that I'd buy more if it goes lower. If they announce a secondary, with few exceptions, and there are exceptions, but with few exceptions, the normal reaction by Wall Street to a secondary is the stock will drop 10% on the news, and then after the secondary is over, the stock will start recovering what it lost. So very interesting stock, very interesting story. A lot of question marks. It's not expensive. So usually if you get a non-expensive stock wrong, the downside's fairly limited. I have a tough time believing this stock goes below 150. So we got $30 to $35 of downside. We've got $100 to $150 of upside. Not bad. If it was at 180 and they had beat the numbers 2 quarters in a row, this would be a table-pounding buy. It's not that yet under my discipline, the top quintile discipline. Lastly, we got Andrew in Binghamton, who's asking about Bros. Surprised you know about Bros up in Binghamton, Andrew. For those of you who've never heard of Bros or Dutch Brothers, Dutch Brothers is the second largest coffee chain in America. It was the third. It's past Dunkin' Donuts. It's still got Starbucks ahead of it. They don't have an inside store. They have 4 drive-through windows. And you can text them your order so it's ready when you get there. And something they've been very, very successful with. They sell thick shakes and slushies in the afternoon. And they've got a big following of millennials. They're only in 25 states. There's 1,200 of them. They plan to go from 25 states to 28 in the next 2 years and open another 800 locations. This was a buy under my strategy when it was under $56. We were buying it last fall. We bought some more in June. Let's go to the chart. The short-term chart actually shows this better. And then it broke out after it reported a great quarter about 3 or 4 weeks ago. Our upside target on this is $81. So at 67, you're really only making about 30% over 2 years. That's not a lot better than the S&P. The way these chain stores often work is you tend to make 80% of the money in the first third of the company's build-out. All these store chains eventually max out in the U.S., and then they either got to stop growing or they grow international, and international has a lot of extra costs and a lot of extra risk with currencies that go down. But this is still a young company. They probably are only in a third or a quarter of their potential locations. They're only in half of the states. So it's not part of my top quintile buy list because of price. If it pulled back to 57, I would make it a buy, or I would buy it here if I knew that they're going to beat the earnings by more than 20 cents a share next quarter, which I don't think they will, but they have typically beat the numbers by 4 to 6 cents. If you think most Americans would prefer coffee that's ready when you pull up to the window with your order, and they put all these to-go things on these tables that are hot, so they keep the coffee hot. And they would like to pay a third less than Starbucks for that kind of convenience, and they got a great loyalty program. And if you think the youth of America is dying for a new place to pick up reasonably priced thick shakes and slushies in the afternoon, this stock's got a long way to go. But it's a little expensive for me. It's a little expensive for our discipline. There are a lot of great stories out there. We don't want to pay a lot for them. I do believe in what Charlie Munger taught Warren Buffett. Warren Buffett used to only buy cheap stocks, and Charlie Munger taught him in the 70s, you're much better off paying a fair price for a great company than pay a cheap price for a lousy company. Charlie would call them half-smoked cigar butts on the street. Yeah, it's a great price, and it'll work for a while, but it's nothing you want long-term. If this stock pulled back under 60, I'd get more excited. But if you give this stock enough time, you probably will make a decent profit on it. Chart looks great. It's a little overextended, but not bad. And these good stories, when they get a little overextended, they tend to stay overextended for a long time. So let's see here. We got a cautious buy on Dell. Only buy it if you're going to buy more lower. Love to buy Apple if it pulled back. And we are cautiously waiting for Oracle to beat the numbers. And for Bros, we'd like to see it lower. Fluor, I ain't touching it till it starts beating numbers. And it's been flat for a long time because it can't seem to do it. That's it. That's it for us this week, folks. We will send us your stock names you want me to comment on. And I'll do just like I did this week. Tell you if it's a buy under our discipline. And then whether or not it's a good company or a bad company.